Hello everyone and welcome to ESG Matters. Today, we are also going to introduce Normdefy's Enabling Technologies Simulated Index, a Japan-focused portfolio that tracks 30 innovative Japanese companies driving sustainability through enabling technologies. Then, we take an in-depth look at Japan's Emissions Trading System, or ETS, a central component of the country's green transformation policy. As Japan aims to balance greenhouse gas reductions with industrial competitiveness, its ETS is set to influence the carbon market and investment landscape. Stay with us.
In the first segment, we are introducing the Normdefy's Enabling Technologies Simulated Index, a Japan-focused portfolio that tracks 30 innovative Japanese companies driving sustainability through enabling technologies. This simulated index provides a snapshot of advancements in sustainability and resilience, focusing on key areas such as renewable energy systems, energy-efficient solutions, and sustainable materials. The portfolio reflects contributions from industries including engineering, specialty chemicals, industrial machinery, and smart cities, showcasing Japan's leadership in addressing global challenges through innovation. The companies represented in this portfolio demonstrate ongoing progress in areas like renewable energy, emphasizing solar, wind, hydrogen, and biomass energy systems, along with advanced energy storage and smart grids. Efforts in circular economy practices are evident through advancements in recycling technologies, waste-to-energy models, and biodegradable materials. Smart infrastructure developments include energy-efficient building technologies, water treatment systems, and sustainable transportation. It is important to note that while larger companies in the index have made strides in ESG reporting and climate scenario analysis, smaller firms face challenges, particularly in providing comprehensive and quantitative disclosures. This highlights the need for increased transparency and alignment with global sustainability standards to further enhance the positive impact of such initiatives. The performance of this portfolio reflects the broader commitment of these Japanese companies to decarbonization, digital transformation, and community engagement. Through investments in renewable energy, the adoption of cutting-edge technologies like AI and 5G, and a focus on leadership diversity and employee well-being, these companies are driving progress toward global sustainability goals. The Enabling Technologies Index, too, had a slight dip in performance for the past couple of weeks, with the performance varying from a low of 116.3 and a high of 120.0. The mean value of the 2 weeks was 118.54, while the median was 118.65. The performance settled lower than at the beginning of the 2 weeks, with a standard deviation of 1.2294. There was an overall decrease in financial performance over the past 2 weeks. We want to clarify that ESG Matters does not provide investment advice or make any recommendations regarding financial decisions. Our objective is to inform and discuss the trends, initiatives, and strategies shaping the future of sustainability across industries. As we conclude, we encourage stakeholders to engage with sustainable practices, explore collaborations, and adopt innovative technologies that contribute to a more resilient and sustainable global economy.
In the next segment, Japan's ETS is being introduced in 3 phases. The trial voluntary trading period, Phase 1, began in 2023 under the GX League, allowing companies to engage in early carbon trading. By 2026, Phase 2, large emitters will be required to participate, with the system shifting toward compliance-based trading. Looking ahead to 2033 and beyond, Phase 3, high-emission industries such as power and steel will face the implementation of mandatory auction-based allocation of carbon allowances. A closer look at Japan's ETS reveals several defining features. Emission allowances are allocated through 3 key mechanisms. Grandfathering, where past emissions determine allowances. Benchmarking, linking allowances to best-in-class industry standards. Auctioning, set to begin in 2033 for high-emission industries. Companies will have flexibility in managing their emissions through banking, carrying over unused credits, borrowing, limited future allowances, and offsets, using J credits for compliance. To maintain market stability, Japan has introduced price controls to prevent extreme fluctuations and regulatory measures to prevent market manipulation. From a legal and regulatory perspective, Japan's ETS raises important considerations for businesses and investors. Under Japan's constitution and administrative law, emission restrictions must be balanced with corporate freedom and fair competition principles. Additionally, as carbon credits gain financial significance, their potential classification as securities could impact taxation, trading regulations, and compliance requirements. For investors, Japan's ETS presents both risks and opportunities. Carbon allowances are now a tradable asset, meaning companies with surplus credits can turn them into profit. Firms excelling in carbon reduction may also benefit from potentially higher corporate valuations, while sectors focused on green investment, such as hydrogen, renewables, and carbon capture, could gain from government incentives. However, the transition poses challenges. High-emission industries such as steel, cement, and energy will face rising operational costs, making early investments in low-carbon operations critical. Financial institutions must also adjust risk models to account for carbon-related liabilities in loans and investments. Japan's carbon credit market is also undergoing rapid change. By 2026, the ETS will cover 300 to 400 companies emitting over 100,000 tons of CO2 annually. Demand for J credits is increasing, with carbon prices fluctuating on the Tokyo Stock Exchange carbon market. Yet, globally, the carbon credit market has seen a slowdown, with total transaction volume dropping from 17 billion Japanese yen in 2022 to 14 billion Japanese yen in 2024. Spot prices have declined 20% year over year, and concerns remain over the credibility of nearly half of all global credits. The future of carbon markets hinges on the balance between quality and quantity. High-quality carbon removal credits, such as those from direct air capture, DAC, and afforestation, now account for 33% of the market, up from less than 20% in 2023. However, balancing cost efficiency with credible high-integrity credits remains a challenge. A rising trend in pre-issued carbon credits is enabling companies to finance sustainability projects before completion. Looking ahead, Japan's ETS will be fully operational by 2026, and companies must align their carbon reduction strategies accordingly. Key areas to monitor include: final regulatory updates by 2025. Carbon price volatility and potential government interventions. Tax incentives and sectoral exemptions. Mandatory auctioning for major emitters starting in 2033. For businesses and investors, early preparation is key. Companies that invest in decarbonization now may reduce future compliance costs and gain a competitive advantage. Meanwhile, investors must closely monitor regulatory risks and emerging opportunities in the evolving carbon market. We'd love to hear from you. Should carbon allowances be treated as financial securities or tradable commodities? How can businesses balance cost efficiency with high-quality carbon credits? Comment down below and let us know your thoughts. Thank you for tuning in to ESG Matters. Stay with us for more insights into the policies and market trends shaping the future of sustainable business.